The 2024-2025 Nigerian Tax Reform Bills represent the most significant overhaul of the nation's fiscal framework in decades. While the government presents these reforms as a tool for modernization and equity, they have sparked intense national debate, primarily due to shifts in how revenue is shared and how consumption is taxed. Understanding these laws requires looking past the political friction to the actual legislative mechanics being proposed. The most heated debate centers on the value-added tax, a VAT, derivation principle. Under the current system, VAT is often credited to the state where a company's headquarters is located or where the tax is remitted, rather than where the actual consumption happens. The new bill proposes that 60% of the VAT pool be distributed based on the derivation principle, specifically, where the goods and services are consumed. Initially, there was a controversy. Northern governors and some traditional leaders initially opposed this, fearing it would disproportionately benefit southern states, like Lagos or Rivers, where corporate headquarters and high-volume ports are concentrated, potentially leaving northern states with less revenue. But in the reality, the reform actually seeks to fix the headquarters effect. Currently, if a company sells products across all 36 states but remits all its VAT from a head office in Lagos, only Lagos benefits from the derivation portion. The new law mandates a consumption-based model, meaning if a bottle of water is bought in Kano, the VAT credit stays in Kano, regardless of where the company is registered. This is intended to create a fairer distribution for states with high populations and high consumption, regardless of their industrial base. Another major point of contention is the fear that the government is simply taxing the poor to cover budget deficits. Critics point to the proposed gradual increase of the VAT rate from 7.5% to 10% by 2025, and eventually 15% by 2030, as a recipe for inflation. Sincerely, such a belief is far from the truth because to offset the rate hike, the bill introduces significant protections for the vulnerable. It proposes a 0% VAT rate on essentials, including basic food items, education, healthcare, and even public transportation. Furthermore, the personal income tax, PIT, has been made more progressive. Individuals earning 800,000 Nigerian nairas or less annually are now entirely exempt from income tax, effectively giving a raise to low-income earners. That said about individuals, the reality for businesses is that corporate landscape is also being reshaped. Small businesses, with turnover under 50 million naira, will pay 0% corporate income tax, CIT. For larger companies, the CIT rate is slated to drop from 30% to 25% over 2 years. However, to prevent tax dodging by massive corporations, a minimum effective tax rate of 15% has been introduced, ensuring that large multinationals cannot use complex accounting to pay zero tax. Recently, there was a new issue about the harmonization and tax sanity. This is often a less discussed but equally critical aspect, which is the Nigeria Tax Administration Bill.